when I purchase, let's say, gold or silver or whatever I'm doing to prepare for the end game, I'm not doing it just for me. I'm doing it for everyone in my circle, whether they think that they're in my circle or not. Because I know what is coming. I don't know exactly what is coming in terms of what it's going to lead to, but I know that all of the dollars in their bank accounts of the people that I care about, all of the dollars, and all of the stocks, and all of the bonds, most of the stocks and all the bonds of people that I care about, they're not going to be able to be exchanged for anything that can buy anything that they need. At some point, that is going to be true. And when that comes, what am I going to be busy doing? Am I going to be busy doing, oh, well, you didn't believe me, so I'm not going to help you? I mean, I can't convince anyone who doesn't see the world in the way that we do that what is going to happen is going to happen. I can only help them when it does. And hopefully their progeny or their grandchildren or whatever can understand what happened to them. Just like Germans of today's time can understand what happened to their grandparents in 1923, and they're preparing, which I believe is why the inflation rate in Germany, the price inflation rate in terms of consumer prices, is higher than in other places, outside of Germany, because a certain remnant is listening to the previous generation. And you're never going to be able to save the entire generation. It's not going to happen. What you're going to be able to do is preserve a remnant, which is what we're trying to do here. We're not going to save all of society. We're going to save a certain fraction of it, which is what always happens. In terms of how do I see this actually happening now? That's a harder question, but I would say that if you just look at the rate of monetary inflation, just the way that the money supply is moving, if you think about it logically, the more money that is printed, the more people exist that depend on that printing, because the more free money they get. And so the amount of people that are dependent on this inflation gets bigger and bigger and bigger. And as they get bigger, they get more dependent. And so the money supply has to keep not just accelerating, but not just growing, but growing faster and faster and faster. Now, in 2020, we had a point from, around March 2020 to, let's say, August 2020. That was about 5 months where the money supply was pretty much going vertical. And the people that were hired, that became part of the workforce dependent on that money supply, they're still there, right? If they are fired or whatever they're doing, whether they're counting, infections or I don't know what they're doing. They're part of the military-industrial complex. Who knows what the government hired them for? But they're still there. They exist, just like all the classes that exist, based on all the money printing that has happened since even 1971. But for 5 months, it went vertical. All these people are dependent on the continued inflation. And if they are dependent on it, then if that stops for a certain amount of time, then all these people get fired, and you have all these statistics in the news where all of a sudden the unemployment rate skyrockets, and we're in a crazy recession, and the Fed has to print because otherwise the banking system is going to collapse. This is what's going to happen. I mean, we saw the same thing in 2008 when everyone became dependent on housing prices. You had all this class of people that were flipping houses and making money on that, and they all became dependent on it, and then it stopped, and then they were all screaming, and they infected their banks that they borrowed money from. It's all the same stuff. So what I'm saying is, because we had a moment, 5 months, where the money supply went vertical, there's you have to go back to that point where the money supply expansion goes vertical again. It just depends upon when the overhang of all the money that was printed from March to August, which was like enormous. It was like a 50% annualized increase in the money supply that is going that has to be replicated again soon. It's like when a heroin addict, has a certain fix and then gets off it and then has to go back to it. So it's theoretical that you could undergo the withdrawal, but at this point it's too big to be able to suffer. So when does that happen? Exactly when, I don't know, but it shouldn't be too long now because the money supply only goes in one direction over time, and it can't go down for too much longer. And it's been going down since April.
About 3 months ago, there was a story that came out that the Royal Bank of Australia, the RBA, was bankrupt or was insolvent, and they said it can't technically go bankrupt because they can just print money to bail themselves out. Can you talk to us about this phenomenon of solvency of central banks? Why what is it? What's happening? How are the current trends affecting that, and what the significance of it is?
Well, okay, the solvency of a central bank, you got to take a step back to understand it, right? Because a central bank is just a centralized version of other banks, right? So other banks, when they exist in the world, right? When banks started, what is a bank? A bank banks your money, and in return for your money, they give you receipts. That's all banks do. And then sometimes they take your money, they invest it in other things, and they make money for themselves. So if you lived, let's say, in the 16th, 17th century, and you give your money, meaning your gold or silver, because that's what money was and still is, you give it to a bank, and they give you a receipt, and then you spend these receipts, and everyone's going around shuffling around these receipts and spending them. And then a rumor has it that your bank that you gave your money to, they spent all the money on, I don't know, a castle somewhere. Doesn't matter what. They spent it. It's gone. And they don't have it anymore. Then what is the value of that liability that they gave you, that receipt? The value of that receipt is only valuable in so much as the money that they still have in their basement, in the bank, that they banked in their basement. And if the public gets word that all the money is spent, then the value of the receipt that they have will go way down because the people won't want them, because they will know that the value of the receipt, the money that they have for that receipt is almost nothing. So it's the same with central banks. It's just a lot more. It's a lot. It's much more disconnected because there's a lot of different layers there. But at bottom, when you have a euro or a dollar or a yen or whatever it is that you have, what is it that you have? You have the liability side of whatever is on the central bank balance sheet. That's what you have. You don't have a magical thing that can just buy something because the central bank said it. Central banks do not have magical powers. As much as we want to think of that, as much as a contemporary article in CNN or the Financial Times or whatever wants to tell you that central banks are magical and it doesn't matter what their balance sheets say, it matters, just like any other balance sheet matters. So when their balance sheets go down, their unit of liability, the currency that you have in your bank account, goes down in purchasing power as well. So when a central bank goes bankrupt, that means that its unit of liability cannot be exchanged for anything of value that's on its balance sheet. It sounds like technical language, but it's really just several derivative layers of the same concept. When a bank that you deposited your gold with no longer has your gold, right? Because everything goes back into the past. And I understand that it's much harder to grasp your head around that sort of concept. But there is nothing new under the sun, as Solomon said. It's just more convoluted now. But it all leads to the same ending. The same ending that the stuff that is on the balance sheet of the currency that you are spending, which is a unit of liability of the central bank that issues it, has nothing in its basement that is of value. That's essentially what it is. And when central banks go bankrupt, it means that their balance sheets have nothing of value, which is why they are going bankrupt, and that infects the currencies themselves, which they issue. And the more they issue of it to plug up that debt, the less valuable those currencies become. And that is what is going to happen. They're going to fall to zero ultimately.
What, in your latest research, what concerns do you have about central banks starting to have negative equity, and what's driving that?
What's driving negative equity is very simple. The central banks bought all these bonds in order that the government be able to spend money into the economy and bail out the lockdowns or the housing crisis or any other crisis that they've had in the past 15 years or however long it's been. They've bought all these bonds, and the bonds are losing value. And in the meantime, in order to arrest consumer price inflation, they've raised interest rates so that they have to pay more interest on all the money, on all the liabilities that they've issued different banks. Now they have to pay interest on these reserves that they've issued. They have the Fed, for example, has about $5 trillion in reserves that are stuffed in banks' balance sheets. And the higher they raise interest, the more interest they have to pay on these reserves. It's just simple math, right? So let's say now the rate of interest is, what is it, 4.25 or something. On $5 trillion, it's going to be a lot of money. And they printed all that money. So they have to pay interest on it, and they're losing all that money. And the money that they earn is interest on the bonds that they bought. Let's say they bought 10-year bonds or 30-year bonds in August 2020 at 0.5%. So they're earning 0.5%, but they have to pay 4.25. So they're going to lose money. So what do they do to plug up that loss? They print money and hand it out to the same banks that they have to pay money to. So what happens then? The banks that they pay money to because they owe them money, because they pay more money than they earn, they have even more reserves. They have to pay them even more money. And then you have a positive feedback loop that happens. And this is mechanically, from a balance sheet perspective, how hyperinflation proceeds. Because you have more and more money that has to be paid on more and more money. I would say currency, because it's not real money. And it just keeps getting higher and higher and bigger until the currency implodes. And yes, it's true that this is the first time we have seen this on a global level. We've only seen this on a localized level, be it in Weimar or Hungary or Czechoslovakia or wherever it's happened in the 20th century. It's only been countrywide. And yeah, it's going to take a little bit more time for it to happen globally, but it's the same process. There's nothing different. And the question is when? Exactly when? Well, just look at food prices. That's what I look at. And when food becomes unaffordable, then people dump their money for any amount of any real asset they can get. That's hyperinflation from a street perspective rather than a balance sheet perspective. But the balance sheet perspective and the street perspective coincide. Exactly when? You don't know. That is definitely 100% the direction that we are all headed.